Hi everyone, welcome back to Upside Down Data. Today I want to give a bit of a post-mortem of the capitulation we've seen in the crypto market and talk about some different indicators that I think can help us make sense of what happened. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter where we put out regular updates about our risk indicators and more. So first off, I want to say that Joe put out a great video yesterday going through how Celsius, the crypto borrowing and lending company, really kind of a lot of the actions around them kind of really contributed to this huge sell-off that we've seen in recent days. So I'll link that video in the description. Highly recommend going and checking that out to get more context on that. Because Joe covered that yesterday, I'm going to focus on some other things in this video. So the first piece of data I actually wanted to look at was our risk indicator, the upside downside potential indicator for Bitcoin. So I'm showing you here the long-term version, which cares about moves that play out over months. And this is just the price history of Bitcoin color-coded to the risk model. So 5 is high risk, -5 low risk. What you can see is that where we are right now is very much getting into the low risk territory. And I'll actually flip over just to showing the raw output of the model because I think we can visualize this a little bit more clearly here. And so what you can see is that with crypto, obviously we know it goes through these market cycles, or at least so far in its history, it's gone through these market cycles. Well, you'll have some big parabolic move to the upside. You then have a bear market, which finds a bottom eventually. Big parabolic move, finds a bear market eventually, parabolic move, etc. And the UDPI is able to track those market cycles. So it'll get up to around the 4 to 5 level, somewhere in this kind of general ballpark at market cycle peaks. And then it'll fall to below between -4 and -5 in market cycle bottoms, or if the March 2020 crash would be the one exception there potentially. And that's kind of the way that it's been throughout its history. And so the thing that probably stands out to you right now, as certainly to me, is we've re-entered that zone. We are now below -4 on the Bitcoin UDPI. The last time this happened, was the March 2020 crash, and then before that, it was basically market cycle bottoms. This, you can call this a double bottom here in the 2015 bear market, more or less, finding a double bottom down there. But that's really the times in Bitcoin's history when it's been at this level on the UDPI. Has been bear market bottoms. Now, does this mean that this is then the bottom necessarily? That, just because we've hit this level that, we should be loading up the trucks and going from there? Well, in a lot of ways, not so fast. So I'm going to talk a little bit more about some of the considerations on the macro side, which has me concerned, and why, I think there's a very reasonable argument to be made that price could continue going down from here through no fault of Bitcoin on its own, but more because of macro factors just kind of generally wrecking risk assets overall. But what I do want to say, though, is that if we are in a case where the breakdown in the stock market, everything in the bond market, everything else we're seeing, inflation, all that, if that isn't enough to break us out of historical patterns, right? If the stock market is able to find a bottom sometime soon, and if Bitcoin is able to, not capitulate wildly further from here, just kind of consolidate in these regions, then I think very well this could be a mega value zone. We're going to talk about some other indicators as well that kind of are pointing to similar ideas, that at least for Bitcoin's history, these are the times that have been the kind of mega value zones where people acquiring these zones have been very happy a couple years in the future. But again, we don't know if that's going to play out exactly the same. Again, one of the things that we have to be worried about to some degree is that Bitcoin's only existed in a macro bull market. And if we're about to head into a macro bear market, I mean, technically the S&P or the S&P 500 is now in a bear market officially. It dropped 20%. And if that's the beginning of some larger drawdown in the stock market, that's something that Bitcoin's never seen before. And we don't really know how it's going to behave in that type of situation. We have to wait and see. But if we avoid that, this could end up being the point of kind of maximum value. So not financial advice. I want to lay out all of the relevant data as I see it. So I think it's all conditioned on the macro environment, in my opinion, that if there's a more bullish reversal that happens moving on to this year and then into next year, this very well could mark the bottom, and these indicators could be calling it out just as well as they called it out in the past. It's really if we get something, like the 2008 style crash, or a 2000 crash in the stock market where all bets could be off. But I just want to show this because I think it's a relevant point, right? This is a point that is showing that Bitcoin is in a in a high value zone that from the model's perspective, based on everything it knows about Bitcoin from its past, it does not expect a whole lot more downside from here. But again, it's been trained on data from a macro bull market. There is no data from a bear market for it to have trained on. Okay, so let's flip back over here to the Bitcoin chart and just talk about some other things to consider. So I want to talk about some kind of price levels and some things like that to look at in a minute. But first, before I want to do that, let's talk about the macro environment. So I'm going to talk about the stock market first here really quickly. This is the S&P 500 chart. If you've been following this, it has been a brutal last few days. Ever since the CPI print last week that came out higher than expectation, we have just been gapping down 3 consecutive days. That was back on, I believe it was July 9th. That print came out. We're down almost 10%, up to 10%, 9 to 10% from that on the S&P 500. NASDAQ, no better, gapping down, setting in new lows. Dow Jones also gapping down and then setting in new lows. Starting to slow its pace a little bit today, but obviously that's no guarantee of it finding any kind of local bottom. But at least we broke this trend of just gapping down. But risk assets are terrified right now. People are selling off. Basically the idea or the way, or my read of it, and I think a lot of people are looking at it this way, is that one of the things that a lot of market participants were hoping for was that peak inflation would have happened already. That was March, and that the May CPI level would come down lower, or in the most hopeful case, it would have come in lower than expected, which then could have added to the narrative that the Fed will kind of take the gas off of the hawkishness. They'd slow down in their hawkish policy, that inflation would kind of come down, and that risk assets would then be able to resume their merry way back up to the upside. That narrative was invalidated, at least for the time being. May CPI was the highest. It was higher than March. And it really kind of has changed a lot of people's opinions of what's going to happen. Now people are pricing in a way more hawkish Fed for longer, with relief, being expected much further on in the future than it is currently. A lot of fears about a recession are now cropping up. A lot of just pain, a lot of bloody things happening. We also see this manifesting in the dollar chart. So I'm showing you here the weekly chart right here. You see it just gone off, broken, set new local high. And in fact, the dollar has never been higher than, or the last time it was at this level was in 2002. We're talking 20 years ago was the last time the dollar was this high. And the reason that we care about the dollar in the crypto world is that it tends to be the case that when the dollar is rising, then crypto is doing poorly. And when the dollar is falling, crypto tends to do better. And you can kind of use it a little bit like a gauge of appetite for risk. Now, when the dollar moving to the upside, there's less appetite for risk. When it's dropping, there's more appetite for risk. More appetite for risk helps crypto. So this is another thing that we can just look at that's very much signifying, basically it all makes sense. Everything's kind of, going together. Same thing with the bond market. I'm looking here at the 2-year yield chart. And the reason why this one can be useful to look at is that it tends to track, or the Fed's interest rate hikes tend to track the 2-year relatively closely. And so what we saw is that even though the 2-year had started to kind of roll over up here, but then with that CPI print, we're off to the races. Basically, the bond market is saying that it thinks that inflation is not tamed yet, that it expects rates to go higher, so people are selling off. So the way you read a chart on bond yields is that the higher it is, the more selling that's happening. Basically, the more bearish, or the more it would be the equivalent of price moving down on a normal asset. Higher yields means that there's more selling in the bond market. So what we've been seeing really is just a bloodbath in the bond market ever since. I mean, you could argue even since the summer of 21, but especially as inflation has been getting higher and higher and higher, bond market has been increasingly selling off, expecting higher and higher interest rates forward. So all of those go together to kind of paint a picture of a very bearish macro setting, which then makes it very kind of expected to some degree that Bitcoin would be suffering. Although, of course, going back to the video that Joe made yesterday, some of this was due to kind of specific factors within crypto, with Celsius, likely having engaged in a bunch of forced selling of Bitcoin, which really likely was part of why the price has fallen so far. So now let's talk about some kind of levels to watch as we go from here. So I made a video recently about this, just to kind of refresh that here, or kind of update that here. So I talked in that video, everyone watches the 200-week moving average. I talked about that as well. We kind of more closed above it yesterday, but now we're trading, below it. It currently sits at 22.3K. We're currently trading a little under $1,000 below that right now. And I had talked about in that video how, you know, it's not like this is gonna be guaranteed rock solid support or anything like that. And even, you know, if you just look back at Bitcoin's history, you know, it's not always rock solid support. You know, you look back at some of these other bottoms, you know, it is possible for us to wick quite a bit down below it, or even start closing fairly far below it, or even kind of like in this example, trading around it and closing below it on the daily pretty often. And so, you know, it doesn't mean that the support is broken just because we happen to be below it right now. You know, what we really care about is weekly closes. If we start putting a lot of weekly closes below this, that would be concerning, meaning that this level might have been broken through and that the next, whatever next level that might offer support is the one we should be looking at. Now, another level that people look at as being potentially that next line of defense is the 300-week moving average, which is currently at 16.5, 16.6K roundabout currently. And so, you know, should we convincingly lose the 200-week moving average, this might be the next place a lot of people look at as a potential level of support. And the reason a lot of people look at this is what provided support back in the March 2020 crash. Now, obviously, that's just one data point, so there's no real way of knowing if this is actually going to be all that meaningful for investors, if a lot of people are going to be looking at this like they do the 200-week. But it is just one that people talk about, so I figure it's worth mentioning. Now, another thing that's important to look at, in my opinion, is the long-term holder realized price. This is the cost basis for long-term holders. And one thing that's kind of, you know, this offers a more concerning outlook, right? Because with the 200-week, we're there. You know, we're there already. We're below it. With the realized long-term holder realized price, we're still actually above it. And the reason I say this can be important is that for every bear market in the past, every bear market bottom, we've dipped at least a little bit below the long-term holder realized price to differing degrees. You know, only a little bit here, quite a bit here, and then a decent amount here. We bounced off of it here in the March 2020 crash. We're getting awfully close to it again right now. It is currently at 19.9K. You know, we were trading at around 21K. So us going down and touching it is certainly not out of the realm of possibility. And so that would be the next level I'd watch for possible levels of support. Because it did access support back in March 2020. Who knows? Maybe it could be a level that could access support again. Or maybe we're going to have to draw down below it again. And when I did the math the other day, looking at kind of how far of a drawdown that could be to match the farthest down that we've gone before, it'd be around 11K. It'd be somewhere between 16 and 11K was what the math showed for that from current levels. So that would be quite a bearish situation if we end up doing one of these and doing something similar to what we've done in the past, or especially if we match the worst case scenario that we've done in the past. That could be quite a bit lower that we'd be looking at. So no guarantee that we'd be getting there. You know, that things I think would have to get quite bad for us to go all the way down there in any short amount of time. But just something to keep in mind, keep on the radar. Now, the next thing we can look at, though, to think about, you know, where else might we find support, you know, this is similar to the long-term holder realized price, which is basically average cost basis. What I'm looking at here is basically the distribution of coins and where their cost bases are in the Bitcoin network. So this is the realized price based on age of coin. So I've excluded everything younger than 3 months. Everything younger than 3 months. The reason I did this is that, you know, usually with support and resistance, it's usually older coins that are going to be able to offer that. People are moving around so much in these shorter time frames. You know, coins are moving back and forth. Not really all that meaningful. Looking at ones that have been held for a while, for longer, is more diagnostic of where support might be found. And what we can see is that really kind of at around 20K, a little bit below 19K, pretty much at the long-term holder realized price, is where we start seeing spikes in cost basis. So decent number of people have their cost basis here. And then, you know, throughout kind of going all the way down to around 12K, there's a decent amount here. But really, when you look at this, and this is also confluent with that previous analysis looking at 11K, you know, we see the biggest bubble once we start hitting 12 to 11K range. And so if things get really bad, this might be a level to look at as being a potentially strong support, given how many people have their cost bases there, and if they see that as value zone stepping in, etc. But that would, again, be, I think, a much more extreme circumstance. I think things would have to get considerably worse. You know, we'd have to really be entering into a pretty nasty drawdown in the stock market, etc. I think, get down to these levels. But it's something to keep an eye on. It's something to watch for sure. Now, the final thing I want to talk about in this video is just where has the selling been coming from recently with Bitcoin. And so there's this really nice metric that Chain Expose has that's called sell bubbles. You can look at it across the last day, the last 7 days, the last 30 days. I chose the last 7 days because this will include the last couple of days that we've been really selling off, and then also a little bit before that, just so you can get some context. And essentially the way you read this is that a bubble means that coins from this area has been selling, and the larger the bubble means more coins from that area have been sold. So unsurprisingly, most of the coins that have been sold recently have been ones that people bought very recently at around, the 29, 30K range. They're just capitulating out. Short-term holders who are just saying, I didn't sign up for this. I'm not holding this asset when it's falling. I'm just going to jump out, basically. Take a loss, get out of the market. But then I think what's more informative to some degree is to look at, are long-term holders selling? And if they are, where are they selling from? Of the long-term holders who have sold this recent capitulation, who are they? Where have they been? And so, long-term holders are, of course, these people who would be back, more than 155 days in the past. And what we can see is that the long-term holders who are selling, most of them are coming from either people who bought back in the highs of 2021, back in the spring, some people from the summer, and then other people who would have aged in that cohort in this general area here back in like September, October of 21. So more recent long-term holders, right? Not really old hands, kind of more recent long-term holders who have been holding for a while. And you only see very few people who have been selling from any of these kind of other, much more older area. Only one tiny little bubble back here in late 2018. And then a tiny bubble here towards the latter half of 2020 as we started this parabolic run. But really not a whole lot of long-term, of the more OG, kind of the long-term holders are selling at these levels. And so that's one hopeful sign, right? I think it'd be a lot more concerning in this capitulation if this was being driven by a lot of people who are holding from all the way back here. People who are in these cohorts deciding to start capitulating out. Because, these are the people who we kind of hope are going to step in and defend their cost basis. If they're just capitulating out, there goes that whole possibility of support that would be gone. So the fact that they're remaining in the market is hopeful. It might mean that they're still hopeful for higher prices. They don't think it's worth yet liquidating their positions. They're content to hold for now, and they're not adding to the sell pressure. So that's hopeful. We're going to have to wait and see how it unfolds. If they do end up stepping in, one of the things we talked about before is that psychologically cost bases start mattering a lot more as you get towards your cost basis. The closer you get to your cost basis, the more it matters psychologically. And we're getting very close to the average long-term holder cost basis. And so we'll have to wait and see what happens, but that's just something to keep an eye on. So kind of overall, what I'm looking at here is, in normal market conditions, this would be screaming value. This would be, one of those places where people would say, load up the truck. This is about as good as it gets. The problem, though, is that we're in a different macro condition than we were back even in 2018. Even though we were in a similar place where, the Fed was hiking rates, all that kind of thing was going on. There wasn't the inflation that was there. There was more room for the Fed to reverse course and then, help out risk assets. The Fed's not really in that position right now. The Fed needs to bring down inflation, and they're going to do that. As long as they can kind of reasonably look like they're not going to just dump us into a recession, they're going to keep the gas on the hawkish, pedal for the time being, most likely. At least that's my base case. And so from that perspective, then I don't think there's anything that's immediately suggesting there's going to be relief for risk assets. I think we're going to have to see something else happen to change the macro environment before we can really be confident. And that's worrying because the fact that we're already at the 200-week and there's not really much sign of relief on the macro picture means that further downside is quite plausible from that perspective. And so that's why I'm personally still cautious even at these high value zones. Now, it's very possible that in a year from now, I'm going to look back at this and say, oh, that was a stupid thing to say. Like, obviously that was the bottom if we end up, moving up and ripping off to the upside from here. But, I can't say that with any kind of certainty right now that that's a likely scenario in the future. I think this is an incredibly uncertain time in the market. And so that's why I am still personally quite cautious. Not financial advice, you should form your own opinions. That's what I'm looking at right now. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter with a lot of updates, better indicators, and more over there.